Hello, everyone. My name is Wen Te Yun from Wen Yun Advisory. In this video, I would like to share the FBAR reporting experience for 2026. FBAR applies to U.S. tax persons who hold foreign financial accounts. If you are not a U.S. tax resident and you do not file U.S. taxes, this video may not apply to you. For those who do have U.S. tax obligations, this guide will help you understand when FBAR reporting is required and how to avoid common mistakes. Let's begin. Before we continue, let us first understand what FBAR means. FBAR stands for Foreign Bank Account Report. This reporting requirement originates from the Bank Secrecy Act and is administered by the U.S. Treasury through FinCEN. Many people often confuse FBAR with FATCA. However, they are not the same system. FBAR focuses on reporting foreign bank accounts, while FATCA is more closely related to tax compliance and foreign financial assets. In this video, we will focus mainly on FBAR reporting. Now, the next question is simple. When is FBAR required? The key number is $10,000. FBAR is required when the aggregate value of all foreign financial accounts exceeds $10,000. This means the total combined balance of all foreign accounts. Even if each account is small, the total amount still counts. If the combined value goes above $10,000 at any time during the year, FBAR reporting is required. It does not need to stay above $10,000 for the entire year. Even one day above the threshold can trigger the reporting requirement. This slide, title Foreign Bank Accounts. Now, let us look at what types of accounts may count as foreign accounts. The most common example is a foreign bank account. This includes savings accounts, checking accounts, and time deposits. If the account is held in a financial institution outside the United States, it may fall under FBAR reporting. Even if the balance is small, it still counts toward the total aggregate value. These bank accounts are the most frequently reported accounts under FBAR. What about other investment accounts? Actually, foreign bank accounts are not the only accounts covered by FBAR. Foreign securities or brokerage accounts may also be included. For example, accounts that hold stocks, bonds, or exchange-traded funds, certain foreign mutual funds, or investment funds may also fall under the reporting rules. The key idea is simple. If the account is outside the United States and you have financial interest or signature authority, it may be reportable under FBAR. Now, let us look at the FBAR filing deadline. FBAR is generally due on Rios April 15th each year. However, there is an important detail. FBAR automatically receives an extension to October 15th. This means most taxpayers do not need to file a separate extension request. As long as the report is submitted by October 15th, it is still considered timely filed. FBAR is filed electronically through the FinCEN system. It is not filed together with the individual income tax return. One common mistake is thinking the rule is $10,000 per account. In reality, FBAR looks at the total combined value of all foreign accounts, Even if each account is small, the total amount still counts. Another common mistake involves joint accounts. Even if the account is shared with another person, it may still need to be reported. Joint ownership does not remove the reporting responsibility. A third situation involves signature authority. If you have the authority to control or manage an account, it may still fall under FBAR reporting, even when the money does not belong directly to you. This presentation is for educational purposes only. If you are uncertain about your situation, it may be wise to seek additional information before filing. Taking time to understand the reporting requirements may help avoid unnecessary mistakes. FBAR and FATCA are two different reporting systems. Both are designed for financial transparency. FBAR is filed with FinCEN, while FATCA reporting goes to the IRS. They serve different legal frameworks. Failure to report may lead to penalties under U.S. law. So, the goal is simply proper disclosure and compliance. This discussion is educational only. For personal situations, please consult a qualified tax professional. FBAR is not a tax form. It is a financial reporting requirement. The goal is transparency of foreign financial accounts. When overseas accounts exist, U.S. law may require financial disclosure. This reporting helps maintain transparency in the financial system. Proper reporting helps individuals remain compliant with reporting laws. Compliance is about following disclosure rules, not punishment. This discussion is educational only. If you are uncertain about your situation, prior consultation with a knowledgeable advisor may be helpful. Today, many families hold financial accounts across borders. With global assets comes global reporting responsibility. Understanding these concepts helps maintain financial transparency and legal compliance. If you would like more educational information, you may scan the QR code below. Consultation services may begin only after the intake form is completed. Thank you for your watching.